This is the Traders Exclusive Live Trader Showcase. I'm Sherry. This is the quarterly event where we feature expert traders and bring you training and insights from 20 expert traders. We have prize giveaways for everyone in attendance. We're going to do some drawings. We have some surprise interviews. Please check out tradersexclusive.com, where we regularly post articles and video clips with valuable trading tips and techniques. This is also where you're going to find the recordings for this event. And before we get started, we have to share a quick disclaimer. You know it. You should carefully consider whether trading is suitable for you in light of your circumstances, knowledge, and financial resources. You may lose all or more of your initial investment. Opinions, market data, and recommendations are subject to change at any time. Past performance is not necessarily indicative of future results. This is training. You have to do your own research, and you should always verify and research. Todd, Bubba Horwitz of Bubba Trading. He's going to talk to us about trading options, and I think it's this lineup couldn't be any better because, I mean, they should almost all be running simultaneously, right? So let me just tell you a little bit about Todd, and then I'll give him the floor. He's the chief strategist at BubbaTrading.com. And for nearly 40 years, Todd has enjoyed a successful career in the financial industry. He began his profession in 1980 as one of the original market makers at the OEX trading pit at the CBOE, and has traded at all the major exchanges in Chicago. In addition to his career as a skilled trader and investor, Bubba has spent the last decade as a mentor and educator to traders of all levels. He continues to concentrate on the education and training of would-be investors, teaching them the ins and outs of a professional trader. And as founder and chief strategist, he manages the development and distribution of market content, product development, trade ideas. And in his own unique manner, he delivers in a clear, unvarnished way his take on the markets and his recommendations for navigating the often confusing world of investing. Always entertaining, never bashful, and rarely filtered. Horwitz will tell you insights about the market that others either cannot or will not. Wow. Hey,
What's up, Sherry? How are you?
How you doing? How are you?
I'm doing great. I'm in Chicago today.
You got something. It's not even mentioned in your bio, but you do a program for high school students.
Yeah, we put together, when my kids were in high school, they went to Deerfield High School in Illinois, which at the time was one of the top high schools in the state. And every day I'd ask them, what did you learn? And I said, how to take a test. So I had written a book on options, and I went to the superintendent and ended up putting it in 600 high schools,
Wow.
which I paid for myself. I didn't do it for money. I did it to help educate our youth. And
wow.
It's a hard job because the teachers don't want to teach it, which is another problem with this world. I was listening and talking to Kenny, and Kenny did a great job with his presentation and a lot of things that him and I think alike, but we're both, I think, street guys. So that's kind of what it's all about.
Yeah, and that, you're also saying they learned how to take a test. That is
Right.
sad. That is a sad commentary because we need to know how to think.
We need to know how to have some common sense and be able to react to what's happening instead of have to go back and, what did they tell me in the test, which is nothing. It was very frustrating because, of course, when I went to school, you learned a skill. And if you could actually, and not everybody's cut out to go to college, including me. I didn't go to college either. So
I'm not really sure that college is where it's at anymore, to tell you the truth.
Agreed. I mean, it is for some, and it depends on what you want to do. It depends on what you want to do in life, and I think that's what's important. But it's listen, you know what? The world is taking, the states have taken a turn for the worse, and it's unfortunate. Hopefully we can fix it before it gets too serious. There's a lot of bad shit out there.
It is. And we just need to stand up and take notice and do things together, I think.
Agreed.
With that, I'll stop. I'll mute myself and you take it away. I'm going to make you the presenter. about
Okay.
that. That probably would help if you want to share your screen.
Might be if I want to share my screen, but maybe I'll just stare at the camera and smile.
Okay, well, you can do that too. I'm going to make you an organizer. Just
All right.
don't
I
talk for
gotta
about
find
3
which screen.
seconds.
I got so many screens. I got to find which one I got to share.
Okay, well, I'm going to make you the organizer so you can see the questions. It's going to cut out your mic for about 3 seconds. Hold on.
Okay. Cool.
Oh, there it goes.
We're here.
And
Okay.
you're back. Okay, now I'm muted. Take it away.
I'm going to take away my video. Hi, everybody. But I have to look at different screens when I'm talking. And so I'm sure you don't look at the side of my head. So I'm going to get rid of my video. Okay. And what's up, everybody? Welcome aboard. It is great to be with you and a part of this presentation. It's always great to be with this group. But we have a lot of fun. And Kenny did a great job and talked about some of the key things, which is discipline, and more discipline, and including patience, which has to go in there. But we have a lot of different option strategies. I did start as an options trader, and I'm going to go through some of the things that we do and some of the things that I can teach you and share with you. And that's always important because, again, this business, I try to learn something every single day. Okay, I know that there's always more to learn, and I think when you think you know it all, that's your first spot to trouble. Okay. Because you never know it all in this business, and there's a lot of things that come up that you can fix before they become a problem. And I hate when people email me with a problem when we could have fixed it if they wouldn't have waited so long to email me. But in the meantime, this is our options call, and of course every week, every Saturday, I do live training, and I give out trades every week, which I'll show you everything that I do. In the meantime, nothing can stop the man or woman, I have to be politically correct, with the right mental attitude from achieving his or her goal. Nothing on earth can help the man or woman with the wrong mental attitude. Again, life and trading are about your head. It's about the mental side of the game. It's easy to make money. It's hard to lose money. Okay. It's easy to get over leveraged when you're going good and you don't realize the trouble. And if you don't understand the trouble, look at SVB Bank, look at some of the other banks and wait for the rest of them to go to the crapper. But in the meantime, again, it's about positive mental attitude. And if you're hanging around with a bunch of negative people, move on because they're not helping you. Okay. I'm sure you've seen this, but of course, whatever I tell you, options, futures, whatever, they all have risk. And whatever we did in the past has nothing to do with the future, which is why I don't necessarily keep a track record. I'm going to show you last week's results because I do post the results every Saturday morning. Okay. I don't carry it forward. I don't share a track record as a rule because to me, it's about what you're willing to learn. I can tell you that when I did my event in Vegas this year, one of my members gave me a brand new 2023 Camaro convertible. So I'm sure we do a pretty good job. In the meantime, my name is Todd Bubba Horwitz, and Bubba was, how many 6'3" Jewish guys did you know in the 70s? Okay, then when Bubba Smith was around, that's how the name actually started. And when I went to the trading floor, you have to have a badge that identifies you. They didn't have my initials, which most people get. So I said, okay, how about Bubba? And that's what I got. You can see my badge. And I've been trading for 44 years. I am still currently a member of the Board of Trade, but I have been a member of all 3 exchanges. I was one of the original market makers in the SPX, but the key that I care about is everything that I recommend, I trade myself right with you, okay? So you're never alone when I'm trading. And when you see me on TV, you're getting my real opinion based on what our positions are, okay? In the meantime, I think the first thing to understand is that in this business, you're gonna have drawdowns. They are unavoidable, okay? And if you learn to remember that the market is always right and you're not, okay, then you'll be on pace to go to the next level up. And drawdowns, if you know what you're doing and you take the time to learn, you take the time to be disciplined, you take the time to pick your spots, you know what you're going to find out? That drawdown is an advantage to you because it will help you add to your position at the most opportune time, okay? And how do you know when to add? Well, if you understand your win rate or your percentage of yourself of what you're trading, then it gives you a drawdown says, okay, I'm hitting, I should be hitting 62%. I'm hitting 40%. I'm going to draw down. I'm due to turn this around. And believe it or not, it actually works. okay? And it is using the drawdown to your advantage when it is the right time, and trying to aggressively try to chase markets, no good. In fact, I trade futures too. I trade everything. Okay, there isn't a market that I won't trade as long as it's liquid. And every morning I trade futures live with my members for an hour. And for the last for quite a while, but for the last 2 weeks, it's been brutal. And I say, go play golf, go to the pool, get out of here. There's nothing happening. And we have an opportunity to make potentially 120 trades in an hour, and we've been averaging 1 or 2 a day. So again, it's not a great time for active markets, but that's where the options models come in, because you can take advantage of these times as well. Okay, but it all starts with a plan. And if you ever saw Sergeant Bilko, the remake, I mean, I like the original with Phil Silvers, but everything starts with a plan, and it's understanding what are your goals. And when you set up goals, they have to be realistic. Okay, if you tell me that you got 5,000, you want to make 100,000 this year, I'm going to tell you that you're in the wrong place. Okay, you can't do that. It's virtually impossible. Could it happen? Yeah, but goals have to be achievable and attainable, because they make you feel better. They put you in a better position for the next. Okay, you got to manage your risk. You heard Kenny talk about that. Risk is, listen, any idiot can trade. Okay, but how many of you can actually make money doing it while protecting yourself? Because it's not the entry, it's the exit. It's the using risk management to make sure that you're alive and still in the game. In fact, I can tell you that my partner and I, now we always traded our own money. Okay, I still trade my own money. But in the 90s, in the internet bubble, we knew that thing was going to collapse, but we had to make a decision ourselves. Are we going to hold it and take a chance of going broke, or are we going to take our losses and move on and go back just to making money? Well, of course, we made the choice to just take our losses and move on. Yeah, we were right. We would have made a fortune, but hey, you got to make the decision. You got to have the strategy that you want to use. There's in options, there's probably an infinite amount of strategies that you can combine, because combining derivatives helps you make strategies. Your entries, what's going to force you or allow you to enter a trade. Okay, managing the trade and analyzing price. It says trade analysis, but it is actually, as Kenny nailed it, is trading price, because all we are really trading is price, because markets are driven by price discovery. Okay, again, we can talk about manipulation all you want. I don't agree on manipulation, because for every buyer there has to be a seller. Okay, it is equity markets are not driven by supply and demand. Equity markets are driven by price discovery. Okay, and supply and demand, options are driven on supply and demand. And how do we know that? It goes through what implied volatility is. When implied volatility is rising, it means there's a higher demand to buy to open options. Okay, and we'll get more into that as well. But again, order options, they're derivative contracts. Okay, we're trading a derivative of a stock, of an index, whatever it is. Okay, and all it is an agreement that you are either buying or selling the right for every one contract to buy or sell 100 shares. Okay, and of course you can trade as many options as you want in any size that you want, and again, that has to be commensurate with the size of your account. Okay, but again, there are much better ways than just, for example, buying calls or buying puts. But that is where everybody starts to understand what the buying of calls and what the buying of puts are. And I will warn you now, okay, if you're a put buyer and you think the market's going down, which is fine. I mean, obviously, we make a lot more money when markets go down, because it happens so much faster. But when you buy a put, you are long a put and short the market. And I assure you that some of you have made this mistake in the past or may make it in the future, okay, that you will make a mistake thinking that you were short and you actually buy another put to get rid of your short position, but you're really doubling your position, or vice versa. Okay, I have 30K and want to make 60. You can do that. I mean, that's realistic. Okay, that's realistic that you can double your account. Okay, I have no issue with that. Can I guarantee it? No, but I can tell you that that's a very realistic goal. Okay, especially with that much capital. When you have more capital, you have a little bit more flexibility on what you're doing. Okay, so what are the advantages of options? We get the leverage, right? I mean, leverage is a great tool, okay? However, okay, over leverage is not so good. Over leverage will put you in jail, okay? Over leverage will put you out of business when the markets go against you, okay? So again, the advantage is disciplined traders who know how to use leverage. Your risk reward ratio, okay? Now again, I'm not such a big guy on risk reward ratios because I can't tell you which trades are going to work. I can tell you that we play every trade defensively, and every trade that I create and every trade that I teach you has a method of knocking down the risk each and every week by selling more premium against an open position, okay? Unique strategies, again, you can create just about anything you want. There's a lot of ways to buy or sell a stock using options. As a floor trader, because we had basically unlimited margins, we were trading straight risk reversals, which is, if you want to be long, you buy the call, you sell the corresponding put, and you're net long 100 shares of stock, okay? But as a retail trader, you don't have that type of flexibility, so you have to use, like, for example, if I want to be long, I buy the call, sell the put, then I have to buy a put somewhere below that establishes how much margin that I'm due, okay? Because again, with all the computers and every brokerage firm knowing your account to the penny, okay, you have to take care of the margin ahead of time, okay? But you can trade with smaller capital. However, if you're going to trade something that is very active and you want to be an active trader, because of FINRA, you must have $25,000 in your account to be able to trade more than 3 times a week, 3 in and outs. So it's again, I'm not a big fan of FINRA, which is why we use futures for our much more active trading. We're not as active in options because, again, a lot of people want to trade with less than 25,000. The disadvantages are, again, as Kenny mentioned, when you were listening to him, there is stocks that are not liquid. Okay, you better make sure you have liquidity, which means a tight bid offer spread. Option settlement is next day. Depends on what you're trading. I mean, the price settles every day, but expiration is when full settlement comes. But if you're trading illiquid stocks that have very wide bid offer spreads, think about it. Okay, the spiders trade here. Let me throw them up here real quick. I'm gonna use my Thinkorswim for this moment. Okay, the spiders trade in a very tight market. Okay, and let's say, so if we're looking at tomorrow, okay, you're trading at a 5-6 cent market. Okay, so that means you get, for every trade, you're giving up $5 of an edge. Okay, when I was a market maker, that was my edge. Okay, when they decided to go to computerized trading, that took away market makers. But for the most part, the spiders will trade in a 2 to 3 cent wide market, which means you're giving up very little edge. It really doesn't matter as long as you're nailing the trade. Versus if you go to a stock that does not have as much liquidity, okay, let's look at Riot. I don't know, it's a $6-9 stock, but I don't trade them. But I just want to see what the bid offer spread. And here you're giving up 10 cents, okay, on a stock that's only $10 versus I'm giving up 3 cents on a stock that's $400. Okay, you got to watch that because remember, even if you think you bought the bid, you didn't, you bought the offer. And even if you think you sold the ask, you didn't, you sold the bid. Okay, so you can't afford to give up those kind of edges when you're trading. So you must make sure what you have is liquid, narrow markets, two-sided markets, okay, because there's enough other issues that show up. Commissions, now commissions is not as much of a deal anymore because many are low cost, although it's kind of a scam when they tell you there's no charge, because there is a charge. Now we actually use our brokerage house that is $10 a month flat, saves me over $100,000 a year in commission, okay, even at the reduced rates. So, but again, you can use what you have, and certainly I'll be happy to tell you who it is, who I'm using, but we've been using it for years, and in fact, in some of our programs, we use it to automate some of our programs. They can be complicated, but this is where your part comes in, okay? If you take the time to learn and educate yourself, okay, and make sure that you're studying to put yourself in a position. It's not full-time studying. It's putting yourself in a position, okay, to learn the market, okay, then you're going to make much better decisions. So they're not complicated if you do your part, okay? I can only give you and teach you my knowledge, but you have to use that knowledge, put it in practical use, and continue to learn, because what you're going to find out is you're going to see there's better ways to do things. You're going to find out ways to adjust trades, okay? So time decay, look, that's part of the issue that we all have to deal with, but we use a lot of selling, okay, especially now with the, you know, the 1 day, 0 day expiration options. They have created a whole new opportunity, and how long this is going to last, I don't know, okay? But eventually the geniuses will figure out a way to squeeze the premium out of those as well, okay, and not have such high IV for the dailies. But right now we're using a lot of dailies and we're rolling every single day, okay? Now, if you think it's risky, it's no more risk than anything else, okay? This comes back down to very simple, okay? Do your job, be patient, be disciplined, learn it, and you'll have no problem, okay? The basic strategies, again, you can create anything, okay? There are so many different combinations. I will tell you now, whether you become a member or not, one of the decisions you never want to make is you never want to try to buy options for earnings, okay? You're going to get killed, okay? Because you can never take care of the expected move, okay? And, you know, long calls, long puts are fine as long as you have something to sell against them. All right, you have to be defensive on taking care of time decay, because options decay every day, and as you get closer to expiration, they decay faster, and of course it becomes a much bigger problem. Okay, so make sure that when you do this, whether you come with me or you stay wherever you're doing, you got to be committed. Okay, not committed to an institution, but you want to be committed to the trades that you're making and understand exactly what you're trying to achieve and how you're going to get there, okay? Now, you can trade any market. I mean, listen, you could actually trade futures options if you want. I mean, they're all the same. You know, all markets are the same. In fact, I will go to the statement that all charts are the same, okay? All patterns repeat themselves. Here's 8 different charts on 4 minutes. This is what we use when I'm live trading futures in the morning. All charts are the same. Doesn't matter. I'm looking for the same pattern to repeat. I don't use indicators, okay? I use nothing. I use what I call the phases of the market, which is consolidation, which all markets are born out of consolidation, breakout to a trend, either up or down, and then most markets end in what they call a blow-off fashion. And as you can see, this is a clear blow-off. All right, I'm not going to go through the heavy details, but this was a clear blow-off, which of course we did get a sell-off off. Okay, but in the meantime, again, it's learning to understand the price and the price action. It applies to every single market. I trade every single market the exact same way. I do not watch the news. I don't even watch it when I'm on, okay? And I'm on TV, I don't know, 3 or 4 times a week, okay? But I don't care about the news. If you trade the news, you lose. And if you look at yesterday's Federal Reserve, okay, the whole world knew that the Fed was going to hike 25 basis points. The markets rallied into that news, and what happened after the news came out? The markets got clocked. Okay, why? Because buy the rumor, sell the news. Now, risk graphs, if you use them, I'm not a fan. Okay, I'm showing it here because I'm presenting it to you. But trust me, I've never used a risk graph. The last time I ever even thought about looking at them was in 1982 when they came out with a machine called the Schwarzschild. Okay, to me, risk graphs are worthless pieces of crap because they cannot account on trades that carry over time, right? If I'm short this week and I'm long in April, the risk graph can't graph that out. It can't grasp that period. So again, I don't use these, but that just is the basic story of max risk, and you should never, ever put yourself in a position of naked exposure on either side of the market, but especially the short side of the market, because of course, in theory, a stock can only go to 0, but in theory, it can go to infinity. Now we know it doesn't happen, but if you traded through the internet bubble in the 90s, you know it feels that way sometimes. Okay, So in the meantime, we look and we watch, and we're looking to gather and put together a position that gives us either neutral or a position that we are guiding on direction. Now, I tend to stick to more neutral type of trading, and then I get to decide as the market does action. Okay, as the market moves, I get to decide. But there's so many different types of trades you can make, and of course, what should you be trading? Again, I like a lot of weighted double diagonals, okay, which are dead neutral trades. If you ever took the delta calculation, I'm not a big fan of all the Greeks. Why? Because the Greeks are great for a floor trader where you can grasp an edge. But if you're a retail trader, they don't really help you. I think they cause more confusion. I can tell you this, that delta starts at the money. Every at the money option, no matter what time frame you're looking at, no matter what date you're looking at, is going to be 50. Okay. We look at the at the money option in the SPY. Okay. So the stock is trading at 394. The 394 calls at 49.50. Okay. And if I go out to April 23rd, the 394 is just over 50. They're always going to be right at that 50 level, 50 deltas, and they'll go up and down from there. Many of you have tried to surrogate the stock by buying the deep in the money option. I think when you do that, you're defeating the purpose of trading options. The best options to trade are the at the money. They get the biggest benefit, okay, and they give you the greatest opportunity to make the most amount of money, okay. And of course, theta is time decay. I don't need a rocket scientist to tell me that. And vega is volatility. Again, I don't need to know all that because the market will tell me by price. And if I learn to understand what the implied volatility means, and of course, when you look at what IV is, or implied volatility, this is where most traders will fail, okay? Now, if I look at the spiders, and they're right now trading at about a 20% volatility, okay? And that's a little bit high for the spiders, but they can support it. But what you have to know is the stocks that you're trading, what can they support? Okay, what is their average? Okay, again, we can't use the historical except for a benchmark, but every stock will have different types of volatility. And of course, with the weekly options, which you're going to see, now I'm going to throw up Netflix here. Okay, now I can tell you by looking at this chart, okay, by looking at the expectation of movement and the volatility, that Netflix earnings are coming out the week of April 21st. Okay, how do I know that? Because notice the jump in volatility, 49, 47, 46, up to 60, and then it drops back down. So I can tell you if I look at the chart, which I will, okay, and the earnings are coming out when? Oh, 4/18, that's the week of the 21st, okay? And again, if you try to buy those options, more often than not, you'll get crushed because the stock is pricing in for that date a move of $43, okay? So if you buy the straddle for April 21st, okay, so we'll say it's the 320. If I buy the straddle, okay, I'm gonna have to pay $41, which means that stock has to make its expected move or I'm gonna lose money. So if that stock doesn't move $43, I'm gonna lose dollar for dollar on the way down, okay? So remember that understanding this part of it and knowing where you are within the cycle of the stock, okay, is very important to you because we get some jumps. Okay, so understanding the at the money straddle, and if you don't have Thinkorswim, it doesn't matter. I don't use Thinkorswim anymore. I actually use TradeHawk, but this is the easiest to develop. And besides everything, all my positions are open on my other platform. But this will tell you, where you are because they do the calculation for you. But if you don't, must be 4 o'clock. If you don't know that, all you have to do is look at the at the money straddle in any time during that. So if I want to go out and look at Netflix, next year in January of 25, I know based on where that straddle is in April, of January of 25. Okay, I can look at this $147. I know that this stock is pricing in a move of $150, $155 plus or minus over the next 2 years. Okay. I know that by the straddle. That's you multiply the at the money straddle by 1.07. Okay. So again, why I can't explain it all in this short of time, but that's what we use as a floor trader. Okay. Now here is some trades that we have open right now. Okay. Now what can you notice about these trades? Okay. Well, there's a short and there's a long. Okay. Now we use the short, okay, and the dated short. So right now this should actually say the 24th, but I didn't change them yet. But we're long the April, and this is just a straight, what is called a double calendar. Okay. And when you're playing a double calendar, you're looking for the market to stay in somewhat of a range and to collect premium on the market on each and every, in this case, every day. Okay. And we've been collecting about $1 a day, okay, in premium. Okay. So what I'm doing is I'm reducing my debit every single day. Okay. And I'm reducing my risk. Okay. And you can see where I show the credit collected as we go down this. But here are straight double calendars, which we've been experimenting with. This is, and JP Morgan is a double diagonal, weighted double diagonal, which means I'm buying an extra call and an extra put. And for you Delta guys or gals, just go do the math. You'll see that it's basically a dead neutral trade, which will get, if the market, if JP Morgan goes way down, then that trade will get short by itself. If JP Morgan goes way up, that trade will get long by itself. In the meantime, each and every week until its earnings come out, I'm going to be selling premium and reducing my overall exposure and risk. Okay. And of course, here we do that in the SPY and the Qs as well. And if you can see in the Qs, we've already rolled up the extra call, taken some of the profit off the table, and we've already collected $1,000 credit. So right now, my net risk on this trade is $1,400, not including the price of the options. Okay. So I know that's a lot to throw at you at one time. Okay. How do you read this? What's considered high value? The truth is every stock is its own. Okay. And when you look at volatility, remember one thing. This is very important. Okay. Options are fairly priced, except they're expensive. They're never cheap. Okay. Remember, the other side of your trade is a market maker, and no market maker is going to give you ice in the wintertime. Okay. So you really have to understand what you're trading, which is why it's so important to understand the IV part of the equation, because implied volatility jumps not because of the fear factor. That's what everybody wants to tell you on TV. Okay. That's a bunch of bullshit. Okay. That is not correct. The VIX is dictated by options bought to open versus sold to open. When there are more options being sold to open, volatility falls. And typically, volatility is typically falling because a lot of people are selling, for example, naked puts, which is a sell to open trade. Okay. They are selling those because they want to buy the stock cheaper, supposedly. Now, there's obviously better ways to do what they're doing, but who wants to argue with everybody? But at the end of the day, so what happens when you start to see a fall in the market, the sell to open kind of disappear on the put side, and more people are buying puts or covering their shorts. So that creates the spike in volatility. Hence, that's how they came up with the fear index, which is, again, it's a crock of shit, but that's what it is. Okay. Now, this is last week. These are a bunch of trades that expired, and we'll typically carry weekly somewhere between 10 and 15 trades, depending on what's going on in the market. And I'm not showing this because they're all green. Okay. This is how we track them. Okay. And this is where we know this is the debit we paid plus the spread risk. Okay. Because again, remember, it's not just the debit you paid. If you're using a spread inside of there, you have to account for the spread risk. Okay. So these are all trades that expired with the exception of Micron, which is actually an earnings trade. Okay. Which we actually rolled up today, the extra call, and rolled the next week. We get a free roll into Microsoft into earnings, which are next week, I think, to the 28th. Okay, which is what, a week from Tuesday, 5 days from now. Okay. But again, this is what we track this every week. Good or red or green, we track them. It's again, I'm not interested in any one day or any one period, and it doesn't matter to me. What matters to me is that we learn it and we continue to be consistent, because over time, consistency makes money. Okay. Did I miss something? Oh, what did I do? Oh, I see. I did. Hold on 1 second. Okay. So again, you buy calls or puts. You should never buy naked calls or puts. You can end up with them if they're free, but you don't want to start out by buying calls or puts, okay? Because you're giving up too much of an advantage. And if you want to understand what I'm talking about, okay, what am I time wise? I don't want to run out of time. Okay. If I look at, for example, the spiders, okay, I'm going to use the spiders just because it's the easiest to deal with. Well, let's just say I was bullish to spiders, I want to get long. Okay, so how would I get long the spiders? Well, I could buy the at the money call. Oh, we're down to 393 already. Okay, I can buy the at the money call for $10 for 23 days. Oh, okay, I mean, again, I need a $10 move, or I can create a trade. Okay, so I'm going to start out with the collars and this is the original risk reversal. Okay, which what floor traders use. Okay, which I'm buying the call, selling the put. Okay, but the difference here is there's no margin benefit for me because it's just like buying the stock. I'm responsible for a short put at $393, which is $39,300. So I have to cut out some of that risk. So what do? Well, I'm going to go and buy a put that's back out of the money a little bit. Let's see. Okay, so now this is a risk reversal. Okay, which I can take this out as far as I want. Okay, so I'm buying this, let's say, for $679. Okay, it is better than and the same as buying this call here, except I'm paying $3.20 less. So I'm paying $320 less per trade. Okay, with just a touch more risk, and that's only if I'm wrong. Okay, so this is one thing we can do. There's another trade you can do if you were long, and you could actually sell a deep in the money put spread. Okay, so we sell a vertical put spread. Okay, so let's sell the 393 and buy the let's sell the 400. My bad. Let's sell the 405 and buy the 390. Okay, so I can reverse this out. Do that way. Oops. I'll do it this way. Or am I at it? That's what I want. So I want to collect a credit. Okay. So what I'm really doing is I'm buying, this is the equivalent of buying the 405 put. Let me open up this window a little bit and get some more strikes in there. Okay. The 405 put is trading at $14.47. Okay. I can buy that same put for $7.80. Okay. By selling the credit spread first. Okay. Now the only advantage I give up is the potential for unlimited gains. However, I'm paying $700 less per contract to start with. Okay, and I can make this as wide as I want. Okay, when I do that, if I want to make it bigger, here I can click the $10 credit. Okay, and what is the probability that the unlimited profit protection is going to come in anyways? Okay, so again, you have to remember what you are looking at and what you are doing. Okay, but so there's a lot of ways to create either a bullish or a bearish trade in the market. Okay, so you buy calls or puts, the answer is no. Do you sell calls or puts? The answer is no. You don't want to be naked on either side. Okay, do you buy debit spreads? My answer is no. I know many of you use them and like them, it's fine. Okay, but I think you're giving up too much. I think if you sell credit spreads, okay, you have a much higher probability for less or the same risk, and you don't necessarily need the movement in the market. Okay, you remember there's premium involved in options. Unlike futures or the stock itself, there is premium involved. Okay, so you want to combat and create the best possible trade for you to avoid the overpaying premium or losing premium. So the best is to be able to sell credit, because my goodness, I have hit my okay limit. Well, I can't help it. That's my trigger. Take care. Thank you for stopping by. Okay, you have to make sure that you put yourself in the highest position of probability, because options trading are a probability model. It is no different than trading, than playing poker, gin, backgammon, or bridge. Those are all games of probability, not games of luck. They're games of skill. Trading is a game of skill, okay? And this is what we are focusing on, is building a skill that can put you in the position of highest probability. So if you're looking at a market and you say, okay, so I want to make a trade somewhere. Okay, well, what do I want to do? So how do I just determine where I'm at? So if I look at a chart, so right now, if I look at this chart, this market is in pretty much consolidation, okay? It's really pretty clearly defined, and if you actually go back farther, you'll see that we've been in consolidation for so damn long, it makes me sick. But that's the market. I can't fight what the market is doing, okay? But basically, you've been stuck in a consolidating range for a year, well over a year. We haven't broken out one way or the other. We keep hitting tops and bottoms. So when you can recognize that you're hitting tops and bottoms, what is the trade that you might want to make? Anybody got a guess of what trade you might want to make? If we're selling, we are more like the house. We are right. We're trying to create the house edge. And by buying options and selling options on a daily basis and buying dated options, we are collecting a premium each and every day, reducing our exposure, increasing our potential profit margins. Okay. Bear call, bull put. Okay, that would be fine. Well, actually, what you'd really be looking for, if you're up at the top end of the range, you would want to short the market or sell a call spread, assuming that the market's going to stay in consolidation. Now, you're not always going to be right. However, you can only play the probability. And based on the last year, if you had sold call spreads at the top end of every range and sold put spreads at the bottom of every range, you'd had a very good year. And again, it's understanding where you are in the phase of the market. And it does not mean that you cannot get long at the bottom longer and create a trade including that. But you want to make sure that you are selling some premium to go along with it, which would be, you know, if I wanted to sell a put spread down here, I might sell a put spread which makes me long, and I might put on that risk reversal trade I showed you that makes me longer. I might sell more than one spread down there. I might sell 5. I might, you know, again, I might change a lot of things. And again, depending on the time frame that you're trading off. Now, I do a lot of trading off of very short time frames because, again, I day trade, I swing trade, I trade it all. Now, obviously, I'm not trading right now because we're here chatting. But if I'm looking at this, what would I be looking at? Well, again, I can see that gold had found a temporary top, which I would want to probably sell and probably try to buy the bottom. Again, obviously, we're never going to get the exact. So how do you identify where your entry point should be at? How do you identify where your entry point should be at? Well, what you really want to do is you want to have a secondary time frame. Now, if you're trading daily, if you're using a daily chart to read your market, you probably want to use a 15 to 20 minute chart as your secondary. It needs to be shorter because that's your trigger point. Now, what we use when I'm day trading futures, I use a 4 minute as my long term. So long-term capital gain is 4 minutes. My short term is 1 minute. And that will be the trigger that will tell me the trade to make if it confirms. So if I see myself getting down, or since we're up close to here, we're down on support on crude. Let's look at that. So if I'm going to get long crude, okay, what do I need? I need my 1 minute time frame, okay, to start ticking up, okay. And right now it's not ticking up. I'm waiting for a green bar to enter. That's what I'm looking for if I'm looking to make that trade. As long as it stays red, there's no reason for me to get in because it's still going against what I might be putting on. And that's what you want to focus on. So right now, it is moving green, and again, I'd be watching it. I'm not going to waste your time watching it for the next 34 seconds, but I would wait for confirmation. So if you're trading on a daily chart, which most of you probably will be doing, unless you're trying to be active, okay? And if you're day trading, it shouldn't be in the futures, in the equity market, it should be in the futures market. But in the meantime, so then I would probably use a 15-minute chart to be my trigger chart. Okay? And you can see that here's where it peaked at the top. And I assure you that there'd be a correlation on the daily. Okay, and actually we can mark it. This was at 3:22, which was yesterday at 2:45 p.m. Okay, so let's say go back to the full daily. Okay, and yesterday, and there you can see there is that bar, and of course it was up at resistance, which would have told me to sell it. And this morning's rally took us right back there, and of course we did sell it, and it would have been a trade to make. Okay, again, obviously I'm going very fast, and I can't do as much as I would like to do in this short period of time. But that's why we do every Saturday morning. We train for an hour, and we give out trades every Saturday without fail. There's a call. I'm live. You can ask me questions. You can email me questions anytime you want. I usually answer. It usually takes me about 3 minutes to answer. I use for credit spreads. I use the daily and a 15. Okay. For a daily, I use a daily chart. Again, I'm looking at it daily because I'm looking to carry it for a little bit longer. However, if I'm trading, I've been doing, and we've been doing a lot of 0-day options, right? 1 day to expiration. You know, they're posted every day, as you can see. Okay, here, 23, 24, 25, and then of course Monday, so 8, 9, 10. So we've been doing a lot of that. So there I'll use a shorter time frame because I know that the trade's going to be over. And once I get through the overnight, the biggest risk in options is overnight. Once they're at expiration day and there's no overnights left, they all collapse. If you've ever noticed, on a Friday of expiration, they all collapse. Okay. How do you manage the risk on a credit? Well, that's a good question. If I do this credit spread, which we're not doing right now, but the risk on this spread is what? It's the width of the spread. So this case is $26, okay? And then minus the credit I'm collecting. But a spread we might be selling, if we're selling call spreads, so maybe we sell the 394, let's say 396 for tomorrow, okay? 394, 396 vertical for tomorrow. Okay, so I get 78 cents credit. My risk is what? The spread risk is 2. The credit I'm collecting is 78. So my risk is $1.12. And I'm selling something that right now is worth 0. So this stock would have to move up to 394.78 before I would lose 1 dime. Okay, 394.78, because I get to add back in my credit. That tells me where my risk takes place. And if you're selling credit spreads and you don't become a member, that's okay too. But I try to get 40 cents per dollar. I want 40%. Those who sell those high probability 10-cent trades, they always get buried. They always end up busted. You need to get a reasonable amount of return because you're going to have to overcome the times when they go against you. You don't want to make 10 trades and be 5 and 5 and be down money. If you make 10 trades collecting 40 cents per dollar, you're going to make a lot of money. And that's what you have to remember. This game is about money and nothing else. It's about learning, but the end goal is always money. Life comes down to 2 things. One is always money. So you have to be prepared to look and then understand the risk. So you always have to count on your spread risk when you're doing this. And of course, you can sell as many as you want. Okay. And typically what I will do is I'll start out with the call spread or a put spread, depending on where the market's at. And should there be a change in direction, which benefits me, I might flip on the other side and turn it into an iron condor as well. Okay, for enough credit that's already covered and locked in a profit, but I might go for it all. There's a lot of different things you can do, which you can only simulate when you're actually doing them yourself. You know, it's hard for me to explain to you every nuance in a short call when we're together here, but I'm happy to do so. 393, only a dollar here, 394, 396. I don't care, it's dollars. Tomorrow's, it expires tomorrow. I don't care. I'm happy to take the chance. I'm at the top end of consolidation. Okay. I'm at the top end of the range. I'm happy. I'll take my shot. I mean, right here, here we're not here anymore. We're in the middle. But I would take my shot if that was the right trade. Look, if it goes against me, I'm gonna lose money. But I know what my risk is. And the trade isn't over until tomorrow. You know, the day's over. So I don't have to, again, if I manage my risk and I know exactly what my risk is, then that's my trade. I don't have to worry about it. I mean, there are trades we'll lose 100%. But again, I'm managing the risk. So I know that my core trades, which I showed you that we make for longer durations, these are trades that I'm reducing the amount of risk either on a daily or a weekly basis. Daily or weekly, I'm reducing my exposure to the market. And I'm trying to get myself into a position, for example, in JP Morgan, I'd like to get this where I have collected $1,200 against my risk, and then I get a free roll. Like next week, going into Micron, I have a free roll. I have a free trade, zero risk. I can only make money. Now I want Micron to move far, one way or the other. I don't care which way it goes. Okay. 394.78 is my break even, is correct. Okay. So again, this is what we're trying to work on. Too many people get a lot of bad advice and a lot of bad information about how to use options correctly. And our goal is to share with you how to do it correctly, how to give yourself the same trade, but take away the risk, take away the time decay, take away the problems of you having to make a decision for your, as they say in poker, for all your chips. And I play a lot of poker, so that's why a lot of poker references, right? I live in Vegas most of the time. I'm in Chicago now, but most of the time I live in Vegas. I have a home there as well. And I play poker 4 or 5 times a week. Okay. But it's the same game. Trading and poker, the same thing. Get the edge, put yourself in position. That's the best you can do. Are you going to win every time? No, you're not. But again, keeping the risk and the discipline under control. In other words, don't see a mirage of a trade that you want to make. Make sure it's a trade that qualifies for what you're looking for. Sold covered calls in 2008 against bank shares. Say, right. Well, that's because you shouldn't be selling covered calls. Covered calls are probably the worst strategy known to mankind. Okay. Now, they weren't bad in 1990 because the commissions were so high. But when commissions started to come down, covered calls became obsolete. You have no protection to the downside, but you give up the upside. What kind of trade? Who would want to make a trade like that? Now, we had all of our portfolios were hedged using options during the collapses, and we got paid and actually bought shares on the way down while we were protected. Again, using derivatives in the proper formation puts you in the best position. I like credit spread on anything. I focus a lot on the things that become most liquid. And the reason I'm talking a lot about the SPY and the Qs today is because they have daily options. And trust me when I tell you that we can create a much bigger edge in those right now because the market has not caught up yet to those trades yet. And that's, people are still trying to buy those. So if you learn how to take advantage of them, and again, as I said, we collected this week, we took out a $1,300 risk on Monday. Okay, we've already collected this week $400. Our risk is now $900, and we have till April 21st. And we have how many rolls up? I can't even count that out, but probably 20 to 25 rolls up. So if I get $1 for each one of those, how did I do for my trade? I think I collected about $3,800 for a $1,300 investment. Not bad, with very little risk. And I'm reducing the risk every day. So with daily option, you can be in today, and we're going to roll it tomorrow. We roll them every single day. Okay. Every day I roll to the next day. I take the credit and roll it out. And we sometimes, in any given day, my rule is if you get over $1 for your first collection, okay, then you can actually put your order in for the next day right now for another $1 or more. And it's a cycle that you do it every day. It should be, it'll become innate to you. Okay. Again, there's a lot of things that we do, and obviously I've been doing this for a long time, and I understand, and I'm still learning. And that's the beauty of the business, because you can create many different products, you're always learning, and you want to learn to put yourself in the best position. Now, if anybody wants to come and join me, okay, this is what I got for you. Okay, every week, every Saturday, I do a weekly training webinar. We put new trades on. Okay, you get daily updates every morning at about, I get up at 1:30. So by 3 o'clock, after I get back from working out, you get an update where we stand and what we're going to do that day. Today, I'm throwing in my Monday night strategy call. Every Monday night, I do a call on general markets, and I give you a lot of my views of what's going on. I recharge for you and give you levels on stocks to watch and tell you what I'm going to do. Okay, if I'm going to make some trades, and that includes futures, I do everything on that call. Okay, in fact, on that call, I cover this whole list. See my night call? I cover this whole list of stocks and securities and futures. Okay, I give you levels on every one of these things. Okay, I teach you how to use the options properly. I have a chat room that you get to become part of, and all of my members are there, and they're always happy. Even when things aren't going great, they still can manage to get by. There's never a negative comment in my chat room. Right? And it's $99 per month or $1,000 annually. It's bubbatraining.com/options or bubbatraining.com/options year. Again, if you have any questions, I'll be happy to answer any of them. And anybody who comes aboard today will get the call. You'll get 2 copies. I wrote a book on options in general, and then they came out with weeklies. So I wrote an option for weekly options. I wrote it with my son, who is now a financial advisor for Edward Jones. And also you will get a 6-session option course that I did for my brokerage firm to teach, okay, as a gift from me. So you'll get the 2 books and the 6-session options course if you become a member today. And that's bubbatraining.com/options if you want to go monthly. You can always convert to yearly, or bubbatraining.com/year, options year. And of course, once you become a member, that is your price for life. You'll never pay more. Yeah. Did you say if I spread $1 right? Yes, I want 40 cents per dollar. Okay, that is the number. Here's the simple formula. Okay, I think I got 2 minutes here. Here's the simple formula. The markets spend 65% of the time consolidating. Throughout any given year, if you look at it, you'll see that 65% of the time the markets is consolidating. So if I'm getting 40% and the market are doing something 65%, I'm basically collecting 105%, which is 5% net. If I learn how to do it properly and weight myself based on the phase of the market, most of my guys make between 17 and 20% just on these types of spreads. How do you get the trades? I give you the trades every Saturday, and if there's new trades, I send an update every single day at 6 o'clock at 3 o'clock in the morning. Okay, every single day I send you an update. And if you have any questions, you can always ask them in the chat room, or you can email me direct, because it takes me 5 minutes to answer every email. No more. If it's more than 5 minutes, it means I probably dropped dead. Okay. But again, at the end of the day, I send you the trades. We lay it out. We talk about fills in the chat room, so everybody knows where we got filled at, and I will tell you, where to work them. I give you a price to put them in. I don't want you to move the price. I want you to let the market come to you. Sometimes we don't get filled. You know what? I don't have to make every trade. Remember, if you get on every trade, you are guaranteed to catch every loser. Let the market, if you miss it, you miss. It's not a big deal. You know what? The markets are open 241 days a year. Okay. So why put yourself in jeopardy? Okay. You don't have to force a trade anytime. You miss, you miss. Believe me, I could give out more trades, but the markets have been so slow. I don't want to give out more. I don't want to overwhelm anybody with too many trades. but you do get an update each and every day. That is to answer your question. Are there any other questions? I use credit spreads, but again, I use a lot more double calendars and weighted double diagonals. Okay, that's, you know, again, I like to be in that position where if I get a huge move in one direction or the other, I'm gonna get paid off. Okay.
That was awesome.
Oh, here. Hi, Sherry.
I'm here. I just don't like to talk over you, and I seem to tend to do that once in a while. So I wanted to be sure that you got it. Hey, I wanted you to know I put your link in the chat so everybody can see it.
Cool.
So everybody needs to go and check that out. And if you have any further questions, you just need to go to the website and hit the contact. Or do you want me to put your email up or Kelly's email?
Can I answer these two questions real quick? I know we're late.
Yes.
I don't want to take up next person's time. The double calendar is risk to the debit that you paid initially. That's the maximum amount of risk, is the debit that you paid. So for example, here, let me just give it to you real quick. This trade here, this is a double calendar. Originally, the maximum risk was $1,300, $1,346 for every one contract. That's it. And that reduces itself every day or every week. There is never a trade I make that has unlimited risk. I refuse to do that. Everything that I say is recorded. I've got I think about 21,000 recorded. I don't speak without it being recorded. Okay, so you always can go back. They're kept on the website for you to go back and archive, and you can listen back to anything you want. Sherry, thank you so much. I appreciate always being invited to this great event. You guys are great.
We appreciate you.
Always fun to be here.
You have a wonderful day, and thank you so much.
Have a great day, everybody. Thanks, everybody, for listening. I appreciate y'all. We'll see you later.